Coverdell, Coverdell ESA. And what a Coverdell ESA is that it acts like a 529 plan where you put the money into that account. That account grows tax free, and you can use that money for your child if it's for private school from middle school, from fifth grade to high school. So let's say we put in $20,000 when they're, in the first grade, got a real estate deal. We made money. We put $20,000 in there. And now when they go to high school, that $20,000 is $80,000. And we want to put them in private school. We can take out all that $80,000, not pay taxes on the $60,000 that it made. And we can use that to pay for their private school. So that is a Coverdell ESA. That is the only account as of today that's out there where you can use the money for private school that is not college. That's a Coverdell ESA. Oh yeah, Mods, put in the chat. There y'all go. There y'all go. Appreciate that. So yeah. So these are you Google? That's cool. So what do they say? Oh yeah. Yeah. So uniform gift minor accounts. And then yeah. So you go. Yeah. So uniform gifts to minors act. That's a UGMA, and then a UTMA, uniform transfer to minors act. And for all y'all business owners out there, which we'll talk about here now, y'all put money in these accounts. If you structure it properly, it's a tax write-off because the IRS is gonna pay you guys for doing that or putting your kids through college. All right. So cool. So number one, how can we do this? So we could do a UTMA or a UGMA or a 529 plan or a regular investment account or a Coverdell ESA. And if we're a business owner, if we structure it properly when we do it, it is a tax write-off. The reason why, because we could pay our child up to $14,000 a year and we can deduct every single dollar. Now you could pay your child more than $14,000 a year, but if it's over $14,300, then they have to pay federal income taxes. So to make sure that Uncle Sam's not knocking on the door for your children, then we want to pay them. I have all our business owners pay $14,000. The child pays no taxes because it's under $14,300. And guess what? You don't even have to pay payroll taxes. So if you're set up as either an LLC or a sole proprietorship, it's very important, right? If you're set up as either an LLC or a sole proprietorship, you don't even pay payroll taxes when you pay them. Typically on $14,000, you're going to pay payroll taxes about $300. So you're going to save about $300 if you're set up as an LLC or a sole proprietorship. Now, if you're an S Corp, which any business owner who makes more than $25,000, I implore you to update your taxation from a LLC to an S Corp because you get to do so much stuff like the Augusta Rule, home office deduction. So, but for whatever reason, we have it where we make less than 25,000. This is for like people like we have people that do real estate. So I could give y'all some game, right? If you guys do real estate, we always recommend that you have two LLCs. You have your real estate, that you do, but then also you set up a property management company. Because now that property management company, you're able to kind of write off everything. So all those repairs you do at the house alone in one LLC, you might not get all those write-offs. You'll get some, but not all. But if all the repairs are done by your property management company, then that property management company, you get to write off everything that you do from a repair standpoint. So this allows you to get more. But typically your property management companies, you're not making $25,000 a year because Rule Section 162, fair, reasonable, and ordinary in accordance with your business in the pursuit of income, most people only charge 10 to 15% for property management. Like you have a property management company that charge 10 to 15%. So like if my rental income is, $20,000, then I'm paying my property management company $2,000. So since it's less than 25,000, like that's the way for you to pay your children through your property management company and not pay payroll taxes because it's set up as an LLC, not as an LLC taxed as an S Corp. But yeah. So, okay, I just made with that game. Okay, I was here. Can I give it out game? Okay, I try to. You guys, allow me to help invest your life savings, help grow your business for our estate planning platform. So the least I could do is help you guys grow your finances. So thank you for that. So yeah, so by doing it this way, the IRS will give you up to $5,180 per child. This is money they're going to give you. And how we come up with that number? So $14,000 write-off, that's 14,000. So if we made 100,000, then from a tax standpoint, a 14,000 write-off means that instead of IRS saying we made 100,000, we made 86,000. Well, if a person is in the highest tax bracket, which is the 39% tax bracket, that is $5,180 that the IRS is giving you. So they're giving you $5,100. And guess what? If it's your children or even your grandchildren, you don't have to give them the money, right? You can put it into one of those accounts that I talked about. You could do a 529 plan, or you can just leave it in your own account, right? They don't have to get the money, especially if it's your kids. Y'all paying for all stuff anyways, right? So a lot of times we have clients that literally they set it up, they pay payroll taxes, they get the write off, but it just stays in their account. So okay, and the IRS pays you to do it. So yeah. The proceeds, or if we want to create generational wealth, all right, we can also place the proceeds in a Roth IRA. So Roth IRA, of course, the money grows tax free forever. But here's the kicker, you guys. You can withdraw the funds anytime, penalty free and tax free if we're over age 59 and a half. However, for our children or our grandchildren, we have what we call a qualified educational expense. And what a qualified educational expense is when the IRS says you don't have to pay either taxes or penalties because it's qualified towards education. Well, what is educational expense? Tuition? Yes. Books? Yes. What about a car? If I have a child that is at a big campus, like Tennessee State, for instance, right? Because we have 3 campuses in Nashville, and we got to go from one campus to another. Am I going to catch the bus? No, I need a car for that. I don't want to miss class. Well, guess what? My car is a qualified educational expense. The gas for my car is a qualified educational expense. So now we can literally buy a car and not pay taxes, because it's a Roth IRA, but not pay that 10% penalty because of it. Hey, my child, we need a laptop. I don't want to buy books. Everything's electronically. That laptop that you buy, anything and everything dealing with school or school related is a write-off. So we did $14,000, paid them, even though the money stayed in our pocket. We put money into a Roth IRA, and guess what? That Roth IRA goes tax-free, and we get to use it and pay no penalties or taxes for their college. And to take it a step further, if you get scholarships, don't have to worry about it. Then it just continues to grow, and they use it for retirement. So yeah, yeah, cool. Yeah, so they put that in there. So violent fence. So again, you guys doing a Roth IRA for your children is another way that you can give the gift of graduation, but have the IRS pay you off for it. Now with the IRA, of course, you can only do $7,000 a year, right? Because they're a child, right? If you're over age 50, you can need $8,000, but it is a limit. But again, a way that you can have some tax-free money. So that's that. Well, actually, if this is good information so far, let's put a 1 in the chat. I just want to make sure um, it's good information for you guys. It might be information that you may know or may not know, but let's put a 1 in the chat. Okay, those ones. And then also, my mom's bear put that in there. But as I'm talking, because we do this every 2 weeks. So like 2 weeks from now, if there's any subject, trust related, investment related, finance related that you want me to talk about, because we always like to use current events as our topics. Except for the one we at the end of the month, of course, that's all estate planning. But still, like, so as we're talking, it's something that you want me to talk about next week or in 2 weeks. We have our next call. Let me know, and the most answers we will do. And there we go. All right, so create a family investment fund. All right. So all my folks with the trusts or my people who use the relax estate from a trust standpoint, we want to use an LLC or a trust to buy assets under a family plan because we'll get even more tax write-offs doing this way. So first off, anytime that we buy real estate, I always recommend that we do it in a LLC. The reason why is because the LLC gives you protection, right? If you have a property that's in your name and something happens to the property's in your name, you're going to get sued. It is what it is. But if it's an LLC, only not the land, but the cash associated with that LLC they can go after. So it's good for you to kind of protect yourself. And I'm always overkill. A person has two properties, I say, put each property to different LLC. Now, yes, when you file your taxes, it's going to cost you an extra $300 because that's a business. But I'd rather you pay $300 extra than something happens and somebody sues you or whatever the case may be, and they go after everything. So you always want to have each separate property in its own LLC. And then that LLC should then go into your trust, right? Because your trust dictates what happens to the LLC if you pass away. So the great thing about a trust is that you're able to control everything and own nothing. So you want to use an LLC or a trust or inside of a trust to buy assets on a family plan. For real estate, stocks, businesses, right? We can do that through an LLC. Kids can become beneficiaries or board members. That's the Augusta Rule. Are you guys familiar with the, because I don't want to glaze over that, because that's another way that every single person who's a business owner can get at least $3,000 to $5,000 of money from the IRS every single year. That's not like a deduction. That's like money the IRS is going to give you by doing the Augusta Rule. So put a 1 in the chat if you guys know, or put a 2, or say you don't know what the Augusta Rule is, and I could quickly explain that, because I don't want to gloss over that if that's going to save you guys money from a tax standpoint. So okay, you go okay, 2. Oh, okay. Give me some game, Mario. Okay. So the Augusta rules. So basically, long story short, with the Augusta rule, it came from Augusta, Georgia. Uh, Georgia. I can't sing, y'all. I'm sorry. I can't sing. But yeah, so it came from Georgia. So Augusta, Georgia is where they do the Masters. That's a golf championship. Well, years ago, the federal government made a deal with that city saying that everybody, since it's a golf tournament, it's a small town, everybody leaves. Everybody who owns a property, doesn't matter if you have a mortgage, but you own a property, right? You may owe money, but it's your property. You're not renting. You can actually rent out your house for 14 for 14 calendar days. And the money that you get, you don't pay taxes on, right? So like, let's say I'm in Georgia, I'm leaving for 2 weeks where everybody comes in and I rent it out to a person. I charge them $1,000 a day for 14. That's $14,000 I receive. And that $14,000 I receive, I don't pay taxes on. It's tax free. I got to tell the IRS, but I do not have to pay taxes on it. So years down the road, people said, hey, this don't make no sense. Why is this little small town able to do it? Nobody else can. So now everybody can do the Augusta Rule. Well, from a tax planning standpoint, by law, your business can rent out to your property as well. So if I'm a business owner, instead of going to a conference room or doing a conference or doing a meeting and paying somewhere, I can do it at my house. And as a business owner, I pay me as a person to do so. Using that same $14,000, I, as a business, pay myself $14,000 a year. We recommend just doing it monthly. So you would do, basically $1,100 a month or $1,200 a month. So $1,200 a month moves from your business account to your personal account. Same money because it's your money, right? But by doing that, it's a $14,000 tax write-off. Since it's a $14,000 tax write-off, like I said, at the 40% tax bracket, that's $5,000 that the IRS is giving you. Even if you're in a 22% tax bracket where you make less than $50,000, that is $3,000 of real money that the IRS is giving to you because you, as a business, are paying you as a person. That's it.